Welcome back to All About Money on HKIBC. I am Chloe Fong. Joining me today is Marcos Chen, the Executive Director and Head of Research of CBRE Hong Kong. CBRE is a global real estate services and investment firm, and we'll talk more about the city's office market as well as the commercial real estate market outlook amid the rising interest rate environment. Thank you for being on our show. And now, following the part one discussions, I want to know more about the office market, outlook as well. And, following this kind of a surging vacancy rate and the supply booms, what would you suggest investors and also the occupiers do following this trend?
Sure, Chloe. I think, office is not a particularly hot sector in the investment market for the time being, because I think a lot of the investors, with them, local investors or with them, institutional investors, they clearly understand the high vacancy situation in the Grade A office market for the time being. So, like I said, they're trying to walk away from the office market. However, if they are coming from a very long-term investment perspective, I still think the office market will have a very good potential down the road. That has something to do with Hong Kong's long-term future being a truly international financial center. I think for the time being, in the very short-term future, unfortunately, because of the high vacancy situation, office rents will continue to trend down a little bit between now and the end of 2023. We do expect, rents probably will come down by another 5 to 10% between now and the end of next year. So I think it represents a very good timing for corporate occupiers to formulate the long-term strategy in Hong Kong and capture the very limited opportunities for them to negotiate some very good bargain deals in the next year or so. For investors, I think they can consider looking into some buying opportunities for some Grade A or even Grade B office buildings and trying to convert them to cater to the needs of some wealth management firms as well as some medical centers demand, because these are some of the booming sector that potentially will be looking for additional space.
Right. So these sectors are emerging, but if we say compare with, for example, the traditional financial services, a lot of banks, they're moving into the digital banking, so they're being more digitalized. So following this trend, they will encourage their workers to stay at home, to work from home, to cut costs. So in this case, would you still remain positive on the office markets in the future?
I think in the case of Hong Kong, work from home is there, but it's not highly popular. I think this has a lot to do with the living environment in Hong Kong, and Hong Kong being a very small city, so commuting from in between home and office is not going to take a lot of time. So if you look into the central CBD, for example, right now, it's very busy. So even though we have just gone through the fifth wave of COVID, but a lot of staffs, a lot of the office workers, they are getting ready to going back to their offices. So I think while we agree that work from home, it's likely to become a global trend more permanently, but for the time being and into the foreseeable future for Hong Kong, I think work from home is not going to make a lot of big disturbances to office practice. So I think it's not something that will determine a very long-term vacancy pressure for Hong Kong. The vacancy pressure is there, but it's largely coming from the supply boom situation.
Right, and ultimately, people are yearning for face-to-face communication as well. And also, I'm also thinking there are more flexible co-working spaces, which are gaining popularity as well. So I'm thinking, how has a flexible office supply performed in Hong Kong?
I think we're still seeing a lot of these so-called co-working center operators looking for leasing opportunities. And we understand that, a lot of these co-working centers, they are doing quite well. I mean, occupancy in many of these co-working centers are maintaining a relatively high level. Although, we're seeing work from home being a new trend globally. But like I said before, in the case of Hong Kong, we're not seeing this being a permanent trend. However, having said that, I think co-working would provide a very flexible option for some corporate occupiers, and it's still going to be a very popular strategy for some startup companies. So we hold a positive view towards the future of co-working centers in Hong Kong.
Now let's also move on to other sectors. For example, some sectors that have been doing relatively well, including the industrial and warehouse segments. So tell us, why have these two sectors are gaining popularity now, and do you think the outperforming will last longer?
Sure. I think if you're coming from a leasing market perspective, then we're seeing a more diversified source of demand for industrial space in Hong Kong. So on top of the very traditional, what we call the 3PL companies or the logistics operators, we're seeing growing demand coming from emerging economic sectors for the like of data centers, for example, coming from the tech sector. We're also seeing growing demand for industrial space coming from pharmaceutical companies, biotech companies, et cetera, et cetera. We're also seeing e-commerce platforms expanding quite fastly in the industrial market. So all these suggest that a vacancy level in the industrial market will very likely continue to remain at a very, very low level. Basically, in a very opposite trend to the office market, industrial market, we are seeing a very low and declining vacancy trend, and that helps to support industrial rents a lot.
Got it. And what about the hotels? You've been saying that the hotels are also emerging to be very competitive, and we can keep a close eye on. So why that?
I think a lot of investors are eyeing on hotel blocks for the last 12 to 18 months. To a certain extent, they are hoping to see a gradual return of tourists if the government would decide to reopen the border gate in between Hong Kong and mainland China. And also they are seeing the flexibility of hotel blocks being able to convert into some co-living space usage. So if the border gate will remain shut, they can always use the hotel blocks for this kind of co-living arrangement. And if the border gate is going to reopen, then they can very soon reconvert the hotel back for general hotel usage. So it's the high flexibility that drives the interest.
Right. And in the short term, for example, in the second half of this year of 2022, do you have any forecast on the sector's performance later on?
I think industrial will still continue to be an outperformer for all the reasons I just mentioned. Low vacancy, rising rent, as well as very, very limited new supply coming into the industrial market. Hotel will continue to be popular, also for the reason that I just mentioned. In particular, we're seeing a higher chance of a gradual travel resumption, hopefully within the next 6 months or so.
Right. Some relaxation is on the way as well. And what about the city's retail sector's recovery? We now know that we're about to be getting the second batch of e-vouchers. So how confident are you on this sector's further recovery later on?
Yes, I think the retail market is also going to do good in the next 6 to 12 months. To a certain extent, you just mentioned about the second batch of the government-backed consumption voucher, and also very importantly, like I said before, if the border gate between Hong Kong and mainland China is going to reopen in the next 3 to 6 months, hopefully, then there is a good chance that tourist arrivals into Hong Kong will see a meaningful rebound, and that's very important to retailers and retail landlords.
Right, and you've been also mentioning about the neighborhood retail sectors that is emerging as well. Just tell us more about this, specific topic as well.
I think neighborhood retail, it's a very prominent sector in the sense that it's very resilient. Occupancy in most of these so-called neighborhood retail malls or retail arcade has been very, very high and has been very, very stable. So when retail rents have come down by 40-50% in many of the core shopping locations. Rents in the majority of these neighborhood malls have always been very, very stable. So even under the recession, we have not seen huge pressure coming into this neighborhood retail, and that attracts a lot of the institutional investors, attention.
Got it. And very quick, one last question. Now we're facing, surging interest rate, and possibly the U.S. Federal will announce further rate hikes, maybe at the end of the month as well. So in facing this kind of a concerning environment and also a possible global recession, are you still confident about the real estate market situation later on? So tell us more about your thoughts on this as well.
Right. I think, given that interest rates are going to hike further in the next 2 to 3 months, I think unavoidably you will see a slowdown in terms of investment momentum. However, it doesn't necessarily have to translate into pressure on property prices or capital values. It all depends on the sector outlook. Interest rates on its own, it's not necessarily going to drive property prices to come down. I think what is more important is the economic outlook, which I admit that there is a lot of uncertainties for the meantime. Economists are forecasting a pretty high chance that the global economy will run into recession once again in 2023. So I think this is the more important concern rather than the interest rate hike on its own.
Got it. Thank you very much for your thoughts today, Marcos. That's Marcos Chen, Executive Director and Head of Research of CBRE Hong Kong. We'll be back on HKIBC next week. I'm Chloe Fong. Until the next time.